I hope you so well. Today we'll learn about how to progressive securing, protecting your nest egg. As retirement gets closer, it's time to shift from aggressive growth to protecting what you've built. Let's look at how adjusting your risk and optimize tax secure your futures. What are your late career income sources? Before we can safely de-risk your portfolio, we need to map your every stream of income that will fuel your retirement years. Uncle Sam tracked this closely and they each have unique tax rules. Pre-tax retirement pots. The traditional 401k and IRA withdrawal that count as ordinary income when you pull them out. Tax-free Roth account. The Roth 401k and Roth IRA distribution that they come to you 100% tax-free since you pay tax upfront. And the taxable brokerage growth, stock and index fund held in standard account, subject to capital gain tax when sold. De-risking and taxes, formulas and thresholds. What is the target bond allocation? A classic rule of thumb to steadily lower stock market exposure. The glide path step, gradually selling equities to buy bonds without shocking your portfolio. Capital gain liability, the tax hit you face when rebalancing a taxable investment account and require minimum distribution, the mandatory amount you must withdraw from pre-tax account after as 73. Why implement a glide path early? Look, transitioning your portfolio isn't something you want to do the month before you retire. If the stock market drops 30% right as you stop working, your nest egg take a massive hit. Gradually, locking again protects your baseline so you can cook up a worry-free retirement schedule. Failing to smooth out your investment risk ahead of time can expose you to seconds of return risk, forcing you to sell stock at a steep loss. Let's take a theoretical calculation to rebalancing hits. Let's look at quick math example for a hypothetical year using simple number to see how moving to safer asset affect your tax baseline. Tax rate shift. The 30,000K moved inside 401K. You have $0 immediate tax. Taxable account shift. The 20K moved in brokerage. You have 20,000 taxable capital gains. The total new tax baseline, only the $20,000 in capital gain impact your current tax bill. S capital gain bracket fit beautifully into the favorable 15% long-term tax tier. Let's visualizing the portfolio risk split. Interpreting the rebalancing section. As you can see, 60% of your rebalancing work happened safely inside your tax sheltered 401k, will only 40% hit your taxable brokerage account. This matters because shuffling assets inside retirement account trigger zero immediate capital gain tax. Always prioritize asset shifting inside your IRAs and 401ks first to keep your tax bill at absolute zero. Real life scenarios. The 58 years old saver. Think about your friend Robert. He is 58 and wants to retire at 63. His portfolio was heavily weighted in high-flying tech stock, sitting at 90% equity and 10% cash. He has 700,000 in a traditional 401k and a 150,000 in a taxable account. He forgot that rebalancing the taxable account all at once should trigger a huge capital gain tax bill by mapping out a 5-year glide path. He is smoothly shifting 5% to bond each year, keeping his tax low and his sanity high. The 401k change 35,000 by years swapped stock for bond inside the tax shield with zero tax penalties. Brokerage change 7,500 by years spread out of capital gain across 5 years to stay in the lowest tax bracket. Tax mitigation tools. Your retirement allies. How catch-up contribution work? Here is the best part. Once you cross age 50, the IRS hands you a legal cheat code called catch-up contribution. They let you stuff way more tax deductibility cash into our retirement account, dropping our taxable income dramatically. The 401k catch-up allow you to contribute 1,000 extra per year over the normal limits completely pre-tax. The IRA catch-up gave you an extra boost to share of taxable dollar while building a bigger bond cushion. H is a steel wolf. Maximize this account allow you to pay for retirement healthcare cost 100% tax-free. What is the expert advice to smooth the risking strategy? First, utilize catch-up limits. If you are 50 or older, maximize your pre-tax contribution to lower your peak earnings tax bracket immediately. Second, build a cash buffer. Keep 1 to 2 years of living expense in a high-yield cash account as a retirement need so you never have to sell stock during a market dip. Execute Roth conversion. Gradually shift pre-tax money into Roth account during low-income gap years to eliminate future RMD tax surprise. Harvest losses strategically. If you have underperforming stock in a brokerage account, sell them to offset the capital gain created by safer bonds. Let's take a key takeaway. Protect the baseline. Shift toward fixed income gradually over 5 to 10 years before retirement. Defend your hard earning wealth. Minimize tax friction. Do your heavy asset rebalancing inside tax sheltered account to prevent unexpected IRS capital gain bills. Leverage is 50 plus. Use catch-up contribution like a financial booster rocket to lower current tax and supercharge your safe haven cash. Stay adaptable. Tax bracket are MD ages and rules evolve regularly. Audit your glide path to make sure it's aligned with the latest legislation. Securing your wealth isn't about giving up on a graph. It's about making sure the money you've spent a lifetime building is actually there waiting for you when you cross the finish line. That is the course for today, guys. Thank you very much and subscribe on our channel. See you soon.